Most unusual hobby. I do a lot of theology research. Well, one of my favorite movies is A River Runs Through It. And for some reason, the book just really stuck with me. I just felt like we had a very similar character and approach on life. And for some reason, that character of all the movies I've ever seen is the closest, I think, to what I see myself as. So that one.
Not many people can analyze investments and communicate fluidly about them. And my guest today can. And he's a special guest, an extra special guest, because he's a former colleague of mine. His name is Todd Wenning, and he writes Flyover Stocks, a Substack blog. And I'm going to tell you a quick story. We worked together at a company called The Motley Fool. We were both there for multiple years. I once got a phone call on my cell phone from a paying customer of my newsletter. And I don't know if I was more surprised about getting that. I don't know how he got my number, or the fact that he wasn't calling about my stuff. He was calling to praise an article that Todd had written. He didn't even know Todd. He was just so happy about this article, he wanted to call me about it. So, Todd, I'm very happy to have you. As a fun fact, Todd hails from the same small town as my dad does. Anyway, we're going to talk about Todd's investing framework. He's a very, diehard fundamental investor, maybe a few stocks or a few sectors he likes, and more. So Todd Wenning, welcome.
Thanks, James. Great to be with you.
So I'm going to start with a little lightning round, not very formal, just let people get to know you. No need to think too much about this. Most unusual hobby.
Most unusual hobby. Gosh. I want to say it's unusual, but I do a lot of theology research. So
that is interesting.
In college, I went to St. Joseph's University in Philadelphia, which is a Jesuit school, and we have a core curriculum. So you have to take philosophy and theology, a couple semesters of each. And I really enjoyed the theology side of it. And so I probably spend it's not as much time as I spend researching investing, but I spend a decent amount of time reading on theology and the analyzing the original documentation and what the words meant as close to the original source as possible, because things get filtered out over time and changed. But I'm trying to understand what the core communications.
The ur text, they say, right? The original,
right?
What do you think of the Bart Ehrman books? Just out of curiosity, do you have an opinion?
Which books? Sorry.
The Bart Ehrman, he's pretty critical. He started out as a devout Christian, and now he's kind of a devout atheist. But he Jesus Interrupted, I think, is one of them, and a few others. I read them years ago.
Oh, I haven't read those. Those are interesting. I'm always interested to hear the logic of people who both came to faith and went away from faith, because sometimes there's some overlap there, and they're substituting one faith for another one in a lot of cases. So I find that process very interesting.
Well put. Maybe we can do a theology podcast one day. I think Bart's moment was like one of his college professors wrote down, like, well, what if Paul just made a mistake? And he's like, in some letter, and then he just kind of like, that thread just kept unraveling for Bart. Yeah. It was pretty interesting. Okay, so back to lightning round. Last book or movie or a related creative work that you saw or read or that had an impression on you.
Well, one of my favorite movies is A River Runs Through It, which is a novella by an author named Norman Maclean. And for some reason, the book just really stuck with me. I feel like of all the characters I've come across in movies and literature, Norman Maclean, who is the author, but also the protagonist of the story, is most like me. Like he's a professor, and that's what I do too. I also teach. And so I just felt like we had a very, very similar character and just approach on life. And for some reason, that character of all the movies I've ever seen is the closest, I think, to what I see myself as. So that one.
Was that the Brad Pitt in the movie?
To be noted, I am not Brad Pitt. So
I was waiting for the likeness. It's close enough. So Jerome Powell, Zero or Hero?
Oh man, he's done a great job. I think
so too.
We have been going through some really unprecedented times, and that's always a phrase that's thrown around. But when you think about the amount of stimulus that came into the economy over COVID and the sort of helicopter money that people were getting to keep their spending going when they were out of work or work was paused or they were earning less, to be able to bring that inflation down. I mean, I don't think that the impacts of inflation are gone. We certainly have had a massive step up in consumer prices since 2019. But at the same time, he has really done a great job of cooling the year over year inflation, which I think is pretty miraculous when you think about just how complex the monetary system is and how little things can really have an outsized impact. So a slip up here, a slip up there could have been disastrous, and done a great job.
Yeah, I agree. I mean, he may have messed up originally, right? Getting too much inflation, but he's done an excellent job. Man, everybody likes to bash the Fed, but I think he's really walked the tightrope very well. Okay, next question. Last time you bought Bitcoin was?
I've never bought Bitcoin.
I thought so. Okay, very last one here. Yes or no? Will we see likely a mean reversion, let's say in the next 2 years, of the following? Small caps / equal weight S&P.
I think that will improve. I think both small caps and the median or the equal weight S&P will improve. Yeah.
Emerging markets
will improve.
Banks.
I think they're probably going to be bouncing around at this level for a while. Just they're not able to earn the returns on equity they used to.
Yeah, I think you're right. And obviously, as we found out, the regional banks are stuck with a lot of that commercial real estate, which, wasn't really priced or marked to market during the post-COVID years until now. And now we're starting to see some transactions, and they're looking ugly. So, I like the bigger banks more than I like the smaller banks.
I agree with that.
All right. So first question for you, Todd. As a history major, if I recall, is that what's the origin story of how you got into investing and how you got your investing philosophy?
Yeah, so it was sort of a winding road. In college, I was a history major, and I minored in econ, but that really didn't prepare me much, I would say, for the investing world. It gave me some sense of, okay, supply and demand impacts prices and quantity demand and things like that. But I graduated, didn't know what I wanted to do. I thought about going to law school, didn't do well on my LSATs. I didn't study. I thought I could just walk in there and do a great job, and I didn't do a very good job naturally. So I thought I'll take a couple of years off, try it again, but I'll be a paralegal in the meantime or something like that. So I applied to a couple paralegal jobs and got that offer. But a friend of mine said, hey, you should apply for Vanguard. I had no idea what Vanguard is. I had no idea what an index fund was or anything like that. But they said, hey, it's in the Philadelphia area, right near where I graduated. And they're looking for registered representatives. So people who take phone calls and place trades for customers. And so I applied, and they must have liked the fact that I had a good GPA and that I had worked on the phone. So when I was in college, I worked in the admissions office, and I would call students who were interested in the school and talk to them about it from a student's perspective. So I spent 4 years doing that. So I had phone skills. I think that was probably the key, right? And so they hired me and got me licensed, and that got me started. And once I got started, I thought, this is just amazing. Being able to, again, coming from a liberal arts background, being able to pull in all these different sources. So, philosophy, economics, history, art, just all these sorts of things I can pull into my daily work. So from there, I was hooked. And really from an investing standpoint, at that point, I really didn't consider myself an individual stock investor, really until I joined you guys at the Motley Fool. And it was in writing to support the various newsletters. So Your Income Investor, for example, Hidden Gems, Stock Advisor, Rule Breakers, Inside Value, all of those newsletters, I was able to kind of sample what made sense to me. So I would write articles in support of each newsletter with an evergreen investing lesson, talking about here's how small caps can really outperform the market over the last 10 or 50 years or whatever it was. And I could learn, okay, insider ownership matters and balance sheet strength matters. And so by doing that, I found myself gravitating to certain types of investments and not so much others. So, David Gardner's Rule Breakers, I really respect David as an investor, and I think growth investing is its own sort of thing. But I felt more drawn to the value and income investing and small cap space that just felt like it matched my personality a lot better. And so that's kind of how I took it from there. I started the UK dividend investing newsletter with the Motley Fool. And then when I went to Morningstar, I was covering the basic materials sector. So I've always been kind of gravitated more towards the value side of the Morningstar style box, so to say.
Interesting. I'm reminded years ago, a guy named Patrick Byrne, who's I don't know if he's still the CEO of Overstock, but at least he was. Kind of a weird, very smart guy, unusual guy, but he happens to be family friends with Warren Buffett. And he once said, and I think he was a theology, maybe a PhD in theology, or somehow he studied theology a lot as well. But he described Buffett as a philosopher who understands investing. And I think that's something, I think we need more of those. And I think you are one of them as well, like someone who can think broadly, liberal arts major. And you wrote a great blog post about this as well, Todd. Someone who can think in a multidisciplinary format. And Charlie Munger is like that as well, right? I mean, he had interest in architecture, a number of different things, psychology. That type of thinking, I would argue, is kind of more needed, because if you go into the investing space, especially Wall Street crowd, you got a lot of smart finance people. And I majored in finance, right? So I'm sort of bashing my own major, but it doesn't breed a lot of creativity. You got a lot of smart people, but not a lot of people who can kind of, cross that blood-brain barrier and bring things together. Because I think there's a minimum ante for technical knowledge, but beyond that, it's kind of like, how does it all fit together? And so it's. I guess I don't really have a real point, except that it's cool to have people like you in the investing space, and I feel like we need more of them.
Yeah.
Actually, let me ask you.
I was just going to say, go ahead. I teach finance at University of Dayton, and one of the things I really appreciate about Catholic universities is that they do insist that all of their students go through these core curriculum, like the philosophy and theology. So even the finance majors get access to those things. I'm not sure how that carries over into other universities, but I know that the Catholic universities, the Jesuit universities, very much insist on that. And I think it's not so much that the finance majors can't develop these skills. They just have to have that interest as well. So when they get into the field, so I think what being a finance major does for you in investing is it gets you in the door. The shops that are hiring you know they don't have to train you on what a PE ratio is. You should know what that is when you come in. Whereas if you're a history major like me, you're starting from scratch, and that takes a lot of time. So I think if you're a liberal arts major and you're interested in getting to the investing world, look at the large companies with existing training staffs where they know it's going to take some time to get you up to speed, and they have the time to get you up to speed. Where if you're trying to join a boutique shop, you're going to have to prove to them that you know what you're talking about before you get in the door, because they just don't have the time to train you on it.
That's good advice. So let me ask you, probably one of the biggest questions in investing is, according to Dow Jones, 94% of U.S. large cap managers fail to beat the S&P 500 over any given 20-year period. What do you think is the case for active management?
I think that the reason that most active managers struggle to beat the market is more to do with having the right match of clients. So I'm thinking out loud a bit here, but I think that one of the things I've noticed, having been on the buy side, is that you have pressures that you don't normally have if you were investing on your own. If you underperform for 3 years and you're managing your own money, you might be a little frustrated with yourself, but you also, if you have a system and a plan in place, you can very much recover once the market weather changes. But if you're managing other people's money, especially if you're managing people who have short-term wants and needs, right? That's not a great match. And so if you can plan to invest for the long term, but if you have clients calling you every quarter going, hey, why'd you underperform by 2% this quarter? Then you start to press. Then you start to take on risks that you normally wouldn't. And so this isn't an excuse. I mean, certainly the industry could do a lot better. But I also think that most buy side or fund managers really have to have that process in place and be selective of which sort of clients they want to work with, and make sure that the time horizons match. I mean, there's certainly funds that match a short-term investor's preferences better, but making sure that the fund and the clients are on the same boat when it comes to time horizon. So, I certainly think that active managers can struggle and certainly do, but there's a lot of reasons for it. But I think that client manager mismatch is a big one.
I'm glad you brought that up, and I think it's an under-mentioned point. And I would argue the whole or much of the investing ecosystem conditions us to have a mismatch of expectations versus time horizon. Most people's real time horizon is they want to have money when they retire. And so that may be 4 decades away, that may be 1 decade away, it may be in retirement already. Whereas the financial media and just the natural human activity bias conditions us to want to watch this, maybe not day to day, although you have no business checking your stocks every day if you're investing for decades. Although that's what many, many people do, or even every week. It should be like a few times a year, maybe something like that, right? But we're so conditioned to massively, really overvalue the near term that it's hard for a professional manager to escape that. Now the flip side, I would argue, and I'm just kind of riffing here too, is that if you're investing for a multi-decade horizon, how do you know if you're good or not? I mean, you could have 5 bad years, you could have a bad decade, but still actually be a really good investor for the long run. So the irony is, by the time you're finally ready to retire, we probably have about enough data to know if you're good enough to do the job you've been doing for your whole lifetime, right? Whereas if you're a day trader, pretty quickly, right? I'm not endorsing day trading, but that's a very quick iterative cycle. Whereas if you're a long-term investor, like, you just don't know if you're good enough until
that's
many,
right.
many years
I
have
agree
passed.
with that. And I've often thought about it as like shooting basketball, right? I played basketball growing up, and I'll go out back and shoot hoops with my son, and within 2 seconds I know what I did wrong if I miss a shot. I didn't have the ball at my fingertips enough, or my follow through wasn't great. I could just tell where the ball landed; it wasn't straight or whatever. With investing, you're right. I mean, it can take multiple years for you to get feedback on an individual idea, let alone your trading strategy. And so I think, I've been doing this for 20 years now, and I've only recently sort of felt confident enough to say, like, this is how I invest, and come hell or high water, this is how I'm going to do it. And that's not to say I'm not open to tweaking processes here and there, that I'm, just stuck in my ways and I'm not changing. But I feel like I've gotten to the point where I'm like, okay, what I want to own are great businesses, and I want to buy them at attractive prices. And then I want to be patient with them and let the managers compound for me in a lot of ways. The less I have to get involved with trading decisions, the better. And that's what I'm trying to do. And so I agree that it's difficult because all of us have, let's call it 50 years, right? We've got from when we graduate college or so, something like we're 22 until we retire, around 72, or even maybe a little bit longer, depending on how long we want to own equities. But that's not a huge sample size, right? And depending on when you start and when you finish and what happens in between, can be a lot of shocks to your investment philosophy. But I just go back to the core principles. What are we trying to do, right? We're trying to ensure that our dollars that we invest today maintain, or obviously ideally exceed their purchasing power over the next 10, 20, 30 years, right? In order to do that, we need to put it into companies that are earning high returns on invested capital and are allocating capital prudently and increasing the value of those assets over time. I mean, that's what we're trying to do, right? That's just the basics of what we're trying to do. And whether you want to approach that through dividend investing or growth investing, I think it comes back to those core principles. And so, for me, that's how I'm approaching things. Is just, what do I believe at the core, and what core principles do I want to hold on to, while staying flexible in the periphery to say, okay, well, maybe I have not done enough work on growth stocks. Like this past couple of years or so has been pretty evident that I have not done enough investing in growth. I think I have 0% tech in my portfolio right now, which has not been great in terms of performance, but my performance has held up pretty well considering I have 0 tech. But it's clear that I just missed that. I wasn't thinking enough about tech. And in fact, I bought some Facebook when it was beaten up, and I sold it for a quick gain, thinking I wasn't prepared enough to develop enough conviction in Facebook or Meta to hold it for the long term. And so I just really have to get better at that. And so that's what I'm saying. Like there are some areas I have to work on for sure and get better at. But the core principles, I think I'm pretty firm in and continue to believe in.
Well, let me ask you this question that's going to relate to your core principles. If you look at Warren Buffett, and your style may not exactly be a Warren Buffett style, but it is certainly more in the fundamental camp, right? he modified some Ben Graham philosophy to at that time, which was a more modern, the Warren Buffett era. You could argue that now we're in an era where intangibles matter more, where tech, human progress over millennia has arguably been parabolic, meaning, we've made more progress in the past couple hundred years than in the past couple thousand years prior to that, with internet, with sharing of information, and that's presumably going to be something that continues. And so you've got all these people, a lot of money that is now copying Warren Buffett. I know you've been to the Berkshire Hathaway meeting. And so that's one perspective. Maybe that's getting a little bit long in the tooth. Maybe what does the next Warren Buffett do? The other perspective is, okay, quality businesses are always going to be in style. You're always going to want to find companies that are adding economic value. Like, that's never going to be broken. And it's also good for society, by the way, relative to day trading. If you're actually being discriminating, finding good companies and avoiding giving capital to bad companies, you're helping the economic system. So there's that perspective. There's sort of a timeless, like Levi's never go out of style element. But then there's another element, which is like, hey, maybe this time kind of is different in certain respects, right? Intangible valuation, tech companies, like what makes a successful firm now is a little bit different from what used to be. Like, how do you balance those two?
That's a really good point. And so that's one of the things that I don't think I appreciated enough about tech, was thinking about how the economics flow through on a unit basis. So on a GAAP accounting basis, they didn't look very profitable. But if you look at the incremental margins that they were earning on every dollar, so once they've had these massive upfront fixed cost investments, and then as they grow, incremental revenue, more of it drops to the bottom line. And so I don't think I gave it enough understanding. But I'm also aware that so Michael Mauboussin and Dan Callahan have done some great work on how intangible asset businesses have kind of broken base rates based on historical, because the base rates were from 1950 to 2015 were more tangible asset heavy, right? And so one of their big takeaways was that intangible asset companies don't necessarily follow the base rates, but they have a wider standard deviation. So there's some that are going to do really well and some that are going to do terribly. And knowing which ones are going to do well is really the trick. Otherwise, you're setting yourself up. I mean, for every Meta success story, and remember, just 2 years ago, we thought Meta was going in the dumpster because of the metaverse, right? For every one of those, there's a GoPro or something that completely flopped, and you should not have. Right.
Probably 10 GoPros or 100 GoPros.
I think, going back to David Gardner, I think he has a really good approach to that type of investing, which is to put just a little bit in all of them, and that the winners will more than outweigh the losers. So if you're going to go picking those type of stocks, just buy small positions instead of making them, 10% of your portfolio. And if they go up, great, but you also have to maintain and preserve capital. So if it didn't go out well, then you're in trouble. So I think there's a balance there as well, as trying to figure out, okay, position sizing wise, because, us in the financial media and in investing profiles and newsletters, like, we're talking about ideas, but we're not always talking about weights, right? So this company's great, but how much of it should I put in my portfolio? Is this a 12% position or is this a 1% position? And we're kind of hoping for. So I don't think that's necessarily clear, because of course it depends on who's buying too. So, the person who likes the idea and thinks I'm going to put this in my portfolio, it depends on their needs as well. So it's not a one size fits all type of advice, right?
Yep. Makes sense. Yeah. And the U.S. has had, I think, 2,400 failed car companies, right? We just got a handful now. We had 900 e-commerce companies in the 1990s. We got Amazon and kind of eBay now. There were 40,000 something cryptocurrencies in 2017. I don't know how many now, but there's that huge, and in AI, right? I wrote a Forbes article last year and said, oh my God, there are like, I forgot, 20 something thousand AI companies on Crunchbase. And just for kicks, last week I looked, and now there are like 63,000. And so how many of those are going to be alive in the next 10 years? Maybe some get bought out, but most are just going to die. So I think you're right that there's this, you have that exciting tech opportunity, but there's especially in the earlier stages, there's just a huge number that are just going to come and then go.
About client expectations is, maybe one of their friends, advisors or whoever bought Meta at the bottom and wrote it up, and they start talking and go, well, how come you don't own Meta, right? And now that advisor is going, oh, I should buy Meta for you. And so I think that is one example of how active management can go wrong, is buying things for reasons other than it's undervalued and I think it's going to be worth more in the future. Buying it for window dressing is one of the key reasons I think that active managers can struggle.
I would say more than 90% of active managers are probably not focused on that multi-decade horizon, and that's probably why more than 90% don't beat the S&P. I mean, it's just hard generally too. It is hard to pick stocks, so let me ask you a very kind of a trite question. Is there an investment that you consider your best investment?
Well,
if so, what was it?
My best investment, the one I'm most proud of because of the position size I took in it, was Costco. So I still own Costco, and I bought it in 2016 or 2016, and held it and continued to add to it, and it became my largest position. And it's just done a great job in generating wealth, and it certainly has gone better than I expected it to. It's really because of the multiple expansion that we've seen in Costco, which has given me some concern recently. It's just at 40 times earnings, that seems a bit crazy. But you also think about,
not cheap.
I've also tried to figure out, okay, well, that sounds crazy to me, but why? Why might it not be crazy? And one of the things I thought about is that Costco's margins are so thin on an operating margin basis that even if it adds 10 basis points, that makes a huge difference at the bottom line. And so there's lots of ways that they can improve that. So international margins are better than their domestic margins, primarily because of healthcare. And as they expand internationally, that should give a lift to margins. There's also a lot of other things they can pull in terms of advertising or something that they could do where they might be able to generate more or better margins over time, and they might be able to earn their way into that. I'm not saying that's going to happen. I'm just saying that's one of the justifications that you could say for the higher multiple, that they're going to earn their way into this. So that's a long answer to your question of which one has been my most successful. So in dollar terms, Costco has been my most successble.
And the follow up naturally would be worst investment and or most painful investing lesson.
I'm planning on writing something more extensive about this because I think it's an interesting one. So I don't necessarily think that my thought process was flawed. It's just that what I messed up on big time was the addressable market. So I think with Peloton, my theory was that, and I've been going to gym since I was 13, so I'm very familiar with the whole gym membership process and how most people give up on their gym memberships. Right. So
remember when you were doing the CrossFit?
So I'm also aware of the fad side of things, but I got a Peloton in 2021, and then my wife and I were using it just all the time. And I thought, this is so different from my experience with gym memberships historically, where, I don't go and I'm just, if it's too far out of my way, I'm not going to do it. It's in my house. That's great. I can just work out here. And I thought, I looked at the numbers of people who join membership gyms every year and how few of them are satisfied and how few of them stick with it. And I thought, if they can just pick up a little bit of those dissatisfied customers, they can really grow this thing quite substantially. And I didn't buy until it had sold off by 50%. So I saw that initial drawdown and I thought, this might be an opportunity based on what I was thinking about in terms of their addressable market. And I just completely whiffed on it because I underestimated how willing and eager people were to get back to the physical gym, even though they weren't going. And the other thing about gyms is they have physical gyms, they have perverse incentives. So they want to maximize memberships and minimize attendance, which is just not a great model, because if everybody shows up, then no one can find a machine and everybody gets frustrated and wants to cancel, right? So I thought Peloton actually has figured out how to make this a virtuous cycle, right? So you can just hop on a bike, and if you don't like it, you can cancel, you're done, whatever, right? So I thought things were going to be better than they did. And the other thing I messed up on big time was underappreciating the overinvestment they had made in their hardware. So, and it's pretty frustrating. So I think COVID was both a blessing and a curse for Peloton. I think if COVID hadn't happened, Peloton would have been this nice, slow increase over time as word spread. But they had this huge pull forward in membership. And what happened was they couldn't fulfill enough bikes for people. Everybody was at home and they needed to work out during quarantine. And so they were flying bikes in from China, like just to fill orders. And the idea being that they wanted to delight their customers, which is normally the right thing to do in principle. It's just that in this situation, they overinvested. They also over anticipated the addressable market. And now they're stuck with all this hardware. And, so I made a couple of misjudgments, but I think in principle, I mean, you look at the renewal rates for continuing Peloton members, and they're extremely high. So people who have bought into the system, their churn rate at one point was as low as people's wireless phones. So extremely low. And so you have this core loyal membership. And I think that's what's keeping it afloat right now. There's this core loyal membership. But obviously I messed up on, go ahead.
And what was the price per year? What's the price per year?
If you just have, so if you buy the bike outright, the full membership, I think, is something like $49 a month. And that, so initially I was using the bike, and then I started using the app, which comes with it, to now I'm doing the rowing and the running on the treadmill. I never used to run on a treadmill, and now I run on a treadmill all the time because I have a coach, right? And so I think the product is one of the best things I've ever bought. And so it's been very frustrating to me as a shareholder and as a user, right, that the stock has just continued to go down, and they haven't been able to figure it out. But I think I just overestimated people's willingness to work out too. I think I thought, well, maybe this is the solution to why people aren't working out. They just don't have the time. Now they have a bike at their house; they can work out at home. But I think the addressable market is much, much smaller than I anticipated. And that was just a crushing part of the thesis.
Not everybody is a fit stallion like Todd Wenning, I guess. Unfortunately. Okay, one quick follow-up on that. So should I stay or should I go is probably one of the most challenging sort of archetypal decisions humans face, right? And there's certainly anecdotal examples on both directions, right? Like you should have just kept on a little more and success was right around the corner, or you should have cut your losses. I think at Motley Fool, we looked at ourselves and the stocks we sold and decided we would have done better had we not sold anything. And I think it's true of my newsletter, especially Income Investor. And part of the reason I sold was not because I thought stocks were bad, is sometimes we just acquired too many stocks, and people would come into the service and say, hey, there's 140 stocks. What do I do? I'm confused. And sort of whittling down that list is at least one way to get at that. Now, a newsletter service is a bit different from a personal portfolio, but what I'm going to ask you is, how do you know when to sell? Like, what advice would you give someone on constructing that sell framework? Is it as simple as saying, okay, decide your thesis, and if that breaks, selling
is my least favorite part of the job. I don't think anyone does it particularly well, including me. Like you said, if we looked at our sold portfolio, we'd probably be a little frustrated with ourselves because this outperformed our ongoing portfolio. And most people, that's probably true. So I think, but I do think there are some things you can come back to. So I do think you have to go with what you believe at that time, right? So that can be valuation. It can be the thesis broke, or that you have a better idea, right? That there's something. Those are the three main reasons why quality investors typically sell: is the price was too high, there was a better idea elsewhere, and the thesis broke. Yeah. And I think, especially when the thesis breaks, you have to get out. Even though the stock may go on to do well, if you held on to it, just saying like, well, I'm going to hold on to it because I know that when I sell, I tend to do it wrong, and I'm just going to hold on to it, and it goes down, you're going to feel double worse about yourself because I knew I needed to sell, but I didn't. And so I do think you need to manage your behavior as well. So one thing I don't think investors do enough, including myself, is to scale up and scale down positions in a portfolio based on thesis changes. So like when you're talking about a newsletter, it's either a buy or sell, right? Or it's either one or the other. There's no nuance. But in terms of the portfolio management side of things, like if I have a very large position and it's well above my valuation estimate, I'm not going to blow out of the whole thing. I can trim it down to a point where I feel more comfortable when thinking about the outcome and the likelihood of that outcome. So if I'm making a big bet on an undervalued stock, that might justify a large position. But if I really believe in the business, but I think the stock's too expensive, I might just scale it down to maybe 2 or 3% of my portfolio. That way I still continue to hold. And great businesses tend to surprise us to the upside too. And I think that's where I often make mistakes is I'll sell a great business because the PE is 20% higher than its 20-year average or whatever. I think it's just a little too expensive. And then I kick myself. And I think when you sell out of a position, you completely forget about it. It's not in front of you. But if you scale it down, it's still in your portfolio. In terms of managing your own behavior, I think it's healthier to have a little piece of that business left in case the stock does improve and the business does better than you expect. You still have some skin in the game, and you behaviorally aren't kicking yourself for blowing out of it.
That's a great point. It doesn't have to be binary. It can be a scalar, and probably should be a scalar thing. One last kind of investing question is any stocks or industries that are catching your eye right now?
With all this excitement about Magnificent Seven and large cap growth, I think there's a lot of opportunity in industrials, and especially in the smaller cap space where there's just not a lot of attention. The small caps have really dragged. But if you believe, as I do, that the U.S. is going to have to make some massive investments in itself over the next decade, whether it's housing or infrastructure or water or whatever it might be, industrials are going to play a major, major role in that. Now, we've been exporting a lot of our manufacturing for the last 30 or 40 years, but some of that's going to start coming home because I think what we realized during COVID quarantines was that we outsourced a little bit too much, and sort of the just-in-time approach to inventory management got in trouble, right? So now we're having to invest in a little bit more slack in our system. So maybe it's not about maximizing efficiency to maximize profit margins, but having a little bit of slack in the system so that in the event of an emergency, we're not going, oh my gosh, we have no antibiotics, right? Or we have no chemicals to manufacture to keep our water clean or whatever, right? Yeah. We're going to be investing more in the US. And so I think industrial companies, especially small caps, which have not gotten a lot of attention over the past couple of years, relatively speaking, is a good place to identify ideas. So that's what I've been doing a lot of in Flyover Stocks, is I've been trying to find some of these Midwestern, primarily, companies that are working in these spaces that may not have a lot of analyst coverage and a lot of attention, but they're worth getting to know because they play a very important role in our ecosystem.
And you like these good, straight-talking, straightforward Midwestern companies. And I guess you're in the Midwest currently, kind of the easternmost part of the Midwest. So if someone is listening to this saying, this is not enough Todd Wenning, I need more, where would you send that person?
Which is my newsletter, my Substack. I'm also on Twitter and Threads, both at Todd Wenning. And we have a podcast for Flyover Stocks. So if someone wants to do a crash course in some of the early posts for Flyover Stocks, I point them there. They can sit down and go through about an hour's worth of content at 1.5 speed, and get up to speed pretty quickly with how I think about things.
Yeah, so that sounds great. Flyoverstocks.com. So what is the genesis of that name, just very quickly?
Sort of reasons for it. So one is I'm in flyover country, right? So people flying between the coasts look down and see Cincinnati. The other thing is it's sort of an homage to the Wright brothers, who are two personal heroes of mine. So they were based in Dayton, Ohio, which is just north of Cincinnati. And they also obviously flew in Kitty Hawk, North Carolina, which is where my wife's family is. And so I have a lot of connections between those two places. And the Wright brothers, I think, are, to me, exemplify Ohio values, right? They're hardworking guys, very innovative, and stuck to it and fought through it despite, yes, exactly. So
super scrappy too. Yeah.
Things for that. And I always say to my kids, about the Wright brothers, I say, look what two kids from Ohio can do, right? You can do anything. You can invent flying. I mean, no one had figured out how to do it, and they figured out everything how to do it. So, to me, they're a big inspiration.
Nice, excellent. So, Todd Wenning of flyoverstocks.com, thank you so much for joining us. It was a pleasure, and hope we can do it again one day. And thanks, as always, to you guys for watching us at home.